Thanks a lot for being here for the last talk of the weekend. Hope you had a great weekend. I did the Princeton Initiative, I think, 13 years ago now. It was great. I'm still in contact with people I met there and met them again and again. So I hope you look back similarly fondly on this weekend. I changed the program at some point. Was about the term premium paper that I also have with Rohan and Federico. You see the video and the slides on last year's program. If you're interested in that paper, everything is there. I thought I'd present you something more recent, which also connects to what I'm working on at the moment. And so I will point kind of these connections to my even more current work out. It's on exchange rates, natural rates, and the price of risk. It's worked together with Rohan Kekre, who is my frequent co-author. So in this paper, let me take a step. What I like about this paper, and which I think is great, like connects to kind of thinking more broadly about macro finance, is that asset pricing data is incredibly useful in informing macro models. That's for me, I think, one of the biggest ambition to look at financial market data. I'm fundamentally interested in macro, but it turns out that asset pricing data is incredibly helpful. I think that's kind of going to become out of the talk, and I think that's kind of useful to discuss in this setting. So we ask what drives exchange rates, and that's a surprisingly difficult question in the literature, persistent literature in international macro. Why? Because the co-movement with exchange rates and consumption growth turns out to be inconsistent with standard preferences and complete markets. That goes back to Backus-Smith, who documented that puzzling co-movement. They're very hard to predict, both going forward and then contemporaneously. And that's Mies Rogoff. And then they're inconsistent with uncovered interest rate parity. Uncovered interest rate parity says you see high interest rates in one country, low interest rates in the other country. It should be the case that an investor that can invest in both of these bonds is compensated with the future path of exchange rates, right? If you have this high interest rate country, maybe it is the case that tomorrow that currency depreciates. So you get this high interest rate, but because the currency has depreciated, the return is worth less. And so you're indifferent between investing in those. In the risk-neutral world, that should be the case. That's not the world we're living in. Hansen, Hodrick, and Farmer showed that interest rates do not predict anything about exchange rates. Instead, they predict excess returns on currencies across countries. I'm going to show you this in more detail in a second. There's a recent literature that says, well, it's exactly shocks to this UIP condition, to risk premia in currency markets, that can rationalize all of these observations. And so what we do in this model, in this paper, we build on the modeling advances of this more recent literature, but then propose a very distinct view of what drives exchange rates. Now, international is always a bit complicated because immediately you have more prices floating around, right? There's an exchange rate. We have to think about what do these prices mean. So slow me down, ask questions. I try to be as clear as possible. I think, again, talking about macro finance, macro international finance is an exciting field. We have fantastic asset pricing data. It clearly matters in current times. I think we can see this very well, there's important questions in international economics. And there's lots of questions that haven't been answered. So what do we do exactly? We study the exchange rate in a general equilibrium model. We have these shocks to currency intermediation. These are going to be shocks to the UIP condition that the literature in the last 10 years has focused on a lot. We're also going to have discount factor shocks. They're going to be really look like patience shocks. The countries are going to want to save or consume more or less. And I don't want you to think about them literally as patience shocks. So I'm going to talk in the end a lot about what they are. But in the end, they drive demand. One country wants at some points to consume more or less relative to the other country. And then there are also going to be endowment shocks. There's going to be two Lucas tree economies. And the fruits that they're paying off are varying. And so they're going to be supply shocks. I'm going to show you some theory in which the co-movements that these three types of shocks, currency intermediation shocks, demand shocks, and supply shocks are inducing, they're going to differ in the co-movements that they induce between the exchange rates and the interest rate differential, and the exchange rate and relative consumption across countries. And so with these differential co-movements in mind, I'm going to show you data. I'm going to separate the world today into a subpart of the world, only the US, and then the G10 currency is going to be a two-country model, and over the last 30 years. I'm going to show you that in the data, it is the case that the dollar is strong when US interest rates are high. And the dollar is strong when US consumption is relatively high. And with these consumption co-movements in mind, it's going to suggest that demand shocks play an important role in driving the exchange rate. then the question, how is this possible? That like demand shocks can drive the exchange rate, looks so fundamental to the macroeconomy, but nevertheless we see these massive movements in exchange rate, and it's very difficult to predict the exchange rate. And so I'm going to go back to the theory and show you, well, if these demand shocks are very persistent, very slow moving, then we can generate lots of exchange rate volatility and very low predictability. And so then the question is, does this quantitatively hang together? And then I'm going to go back to the model and show you the quantitative model. And indeed, we're going to find that these persistent demand differentials across countries account for 75% of the variance of the dollar G10 exchange rate and generate the co-movements as we're seeing them in the data. That said, intermediation shocks, these currency UIP shocks, they remain important. First, to rationalize UIP deviations at high frequency. But there are also these periods in the data where the dollar is strong, even though US interest rates are low, say 2008, these flight to safety episodes. And for those, we need these kind of shocks. Yeah.
And so, for example, right now,
yeah,
the dollar is weak.
Yeah.
And the US yields are high. And so, what do you say about that?
Yeah, so that's going to look much more like a shock, like this shock here in the end. The recent episode, I think I'm kind of, the data I'm going to show you ends pre-Trump, and then I think interesting stuff is happening. And we're going to see many other episodes that look like the episode that you are describing, where clearly it is about you have either low interest rates and a strong dollar, surprisingly, or you have a weak dollar as now, and interest rates are nevertheless high. And then these must be shocks that look like these kind of shocks on the right-hand side of the on the UIP condition. That said, it's all going to be always about the relative interest rates. So to me, it's not enough to say US interest rates are high. The question is always what is happening in all the other countries. Yeah.
And so US dollar also has a special kind of position in the asset, right?
Yeah. That's also going to be everything that is special about the dollar, and Ron and I have worked on this as well as kind of a driving force in the global business cycles, this kind of time-varying special role of the dollar. All that is going to be here on the right-hand side. The key question that is going to come back is how persistent are these fluctuations to the specialness of the dollar versus what's driving the exchange rate. Yeah? And then there's a level component. I'm not going to say anything. It's really here today. I'm going to try to talk about variation. There might be a level component to the specialness of the dollar. I'll show you the theory in a second. I think that will kind of clarify these ideas. Yeah.
Since 2008, the US started offering interest reserves, and like a lot of international banks started backing. Like there's this literature by Wenchel who would say that. So where should I put that in the three currency intermediation demand?
Yeah, so it's going to be a very stylized model, but all of these kind of like special demand for the dollar is going to be here look like a currency intermediation shock. Let me show you the model, and I think then it's going to be a little bit more clear. The model is going to be very simple. It's not going to have all those details, but in terms of wedge accounting exercises, we can ask what is that? There's a wedge that the model needs now to fill through a shock, and what does that could that correspond to in the data, and then we can think about these kinds of episodes. Exactly. So I'm skipping the literature, but there is a huge literature on kind of wedge accounting of currencies, and as we're kind of relating to this by writing down a simple model and then asking where in that simple model do we now need to enter deviations, and where would the model need more richness, part of the wedge is that one. Great. Model is very simple and directly built on Itzkoki-Muken. So if you have seen the Itzkoki-Muken model, exchange rate disconnect, then this is going to be largely that model. I point out that the small differences vis-a-vis that model. There's a US and there's foreign. US has size 1, and foreign has measure zeta star. G10 slightly bigger than the US. In the empirical calibration, in the quantitative calibration, is going to be a bit bigger than 1. There's going to be distinct endowments in home and foreign, so these two different trees. The US representative household has constant relative risk aversion, IES of psi, consumes CT. And then one key difference maybe from your standard problem, as you notice, is that there's this time-varying time discount factor in there. It's just going to have this time-varying demand feature as one of the driving forces in the model. Consumption that this household is consuming is a bundle of the foreign consumption good and the home consumption good. If consumption was unbiased, then we should consume as much of the home good as the US has proportional size in the world, which is 1 over 1 plus zeta star. But as usual in this literature, there's home bias. We are assuming that there's home bias. The US consumer puts additional weight on the US consumption good and puts less weight on the foreign consumption basket. That's going to lead to exchange rate movements because the home and the foreign consumer are consuming different baskets in the end, composed though of the same underlying goods. Maximizing utility subject to a budget constraint. The household buys the home consumption good, buys the foreign consumption good, and can save in a home bond. A home bond has a real rate of RT. What funds are available for the consumer to spend on? Well, there's the bonds that the agent had to save and come into the period. This is real bond that now pays off BT minus 1. There's the fruit of the tree, ZT, that have a certain price, PT, they're paying off in this period. And then there are two profits. One's coming from the intermediaries that I'm going to, the arbitrageurs that are coming, I'm going to explain in a second. There's also going to be markups that are produced in a sec, and I'll come back to those in a second. That's the optimization problem. The optimization problem is symmetric for foreign. So for foreign, the only difference is that there is a different time-varying time discount factor beta star. There's a different endowment Z star. And the foreign agent can only trade in the foreign bond, foreign real bond that pays off in units of the foreign consumption good.
Do arbitrageurs only rebate to US households or do they rebate to foreign households?
They only rebate back to US households. I'll show this say this in a second, but it's going to be qualitatively and then quantitatively not going to be important. But that's the assumption that we're making.
I don't understand why the price of consumption is not the same as the price of the fruit.
Perfect. I'll separate them slightly in a second. There's going to be that's where the markups come in. Let me give me one slide and I'll come back. This is a great question. Yeah.
I'm not sure, but does the subscript of beta starts from 0, time 0, or t plus tau? So it's a discount factor. So I think we're standing at time t.
I think
Cumulative.
it's cumulative. No, I think it's right. So we are both are starting at 0. We are starting off at 0, right? If you now want to think about how much are we discounting consumption in period t, 3 periods from now, then it is beta 0 times beta 1 times beta 2 times beta 3. This is a product of over all those betas.
The expectation.
Yeah. Yeah, Marcus.
How do you deal with time consistency?
How do I deal with time consistency? No, I don't think there's a time. I mean, there's an expectation around this, but you're actually optimizing those preferences, actually taking into account. I mean, in a second, I'm going to do first order everything. Then these things are gonna not matter anymore. But the agent has the expectation over the time discount factor being varying. But once I'm doing first order, the question kind of necessarily drops out. Yeah.
This is maybe like a theoretical question here, but like I always struggle to see how those markets could be segmented, because even me as a sophisticated guy as it goes, like I have a dollar account, I have a euro account.
Yeah.
I could see totally, like say for Russian ruble, indeed it's like difficult to move money inside and outside, and there's like whatever, if you go Raiffeisen, then it will be a big deal. But like dollar and euro, I could even go short. Like even if I active brokers, I could borrow against my stocks.
It is surprising. I mean, trading international bonds is surprisingly requires surprising sophistication that most people don't have access to. I mean, with an interactive brokers account, you do, but most don't. All of the theoretical insights go through, if you put some inelasticity in there, some costs of trading it, but of course they get quantitatively weakened. So we have a version of the model where instead of having such an extreme form of segmentation, we allow the home agent to trade the foreign bond, but they have some portfolio target, they don't like deviating away from this. The question is then, how big is that inelasticity? Clearly, kind of we know from Barker-Smith, we cannot be in the complete markets world. We need to be even more complicated. So Lustig and Verdelin say it's even more complicated than just saying, well, maybe let them only trade bonds, because even that does not work. Yeah. So we need some form of inelasticity or segmentation to make things work. Here we're speaking to a literature. To some extent, this paper is also somewhat literature-driven. We're just following its Skokimukken and come to different conclusions to them. I'm very happy to entertain, and we're doing this in subsequent work, kind of inelastic trading of foreign bonds as well. But yeah.
I think maybe an alternative way to think about this is you can trade bonds, you cannot compute expected returns or anything because you just don't have a model for this. As an individual investor, you can do like stochastic orders and you become a horse trader.
I'm not sure. Yeah. I'm not sure whether I. Anyway, let's. Let me not entertain those. I'll run with this assumption for now. And it's important, so this is an important realization here. I have made a stark assumption that it's Skokie Mookin are making. Home agents trade the home bond. Foreign agents trade the foreign bond. They want to trade with each other. How do they do this? Well, they need someone in the middle, and this is going to be the roles of the arbitrageurs. Yeah? To some extent, they're capturing some of the inelasticity. These are, you can think about these are the interactive brokers, but of course it's key that there's some key elasticity issues here. So we're following directly Gabek's Majori and its Skokie Mookin. An arbitrageur sits in the middle, can trade the home bond, can trade the foreign bond, but necessarily takes currency risk onto the balance sheet while doing so. So how does this work? They enter the period with zero wealth. They live for one period. They can buy the foreign bond. They can buy the home bond. They can buy the foreign bond. Has to budget constraints says this has to add up to zero. I'm going to talk about it a lot. Although the results I'm talking about are going to be not dependent on that, but I'm going to talk a lot about the foreign agent is going to go long the foreign bond and going to borrow in the home bond. So we're going to kind of have a positive position here, negative position here, adds up to zero. In the next period, uncertainty is realized. What is the uncertainty? Is the exchange rate. From the US arbitrageur's perspective, the foreign bond investments are now worth more or less depending on how the exchange rate has moved. And this is going to show up here as profits. And these profits are the ones that are going to be distributed to the US household, although it will not matter for what I'm going to talk about. Yeah.
Is the steady state level of debt unique?
Yes.
And it is from the arbitrageurs that you get that? There's no like portfolio adjustment cost. You get it from their problem?
Yeah, I'm getting this. So this is kind of the nice thing about this model is that we can have permanent beta differences. So one country can be more patient than the other, and in fact we're going to have that in the model. And different from a lot of the international literature, here there's kind of not going to be any problem of non-stationarity because at some point the arbitrageurs will have lent so much to the impatient country that the arbitrageur says more I'm not willing to take on my balance sheet. And that's going to lead to a steady state value of borrowing and lending that now just requires constant repayment of that debt from the more impatient country. And where does this kind of the steady state come from? Is because the arbitrageur is not willing to do more of it. It's kind of like you might have seen these Uribe-Schmidt-Grohe tricks of like let's put some costs on the interest rate. It kind of goes in the same direction, but kind of fixes steady state. Yeah. Okay, so the arbitrageur doesn't like risk, and that's the point here. They like profits. They maximize these profits, but with the exchange rate risk comes risk on the profits. They're not liking this. It's a very simple mean variance problem, but the risk aversion with which they're not liking this is going to be time varying. So gamma t is going to be time varying. It's still going to be the last driving force of the model. And that is, for us, the equivalence to the noise traders that you might have seen in its Skokie Mookin. It has the exact same feature that the arbitrageurs are sometimes more and sometimes less willing to arbitrage or take on currency risk on their balance sheet. With the noise traders is because beyond trading between home and foreign, they suddenly get additional currency flows onto their balance sheet that they need to intermediate. It's kind of adding additional quantities here. For us, we're just making it about risk aversion. Yeah.
Is it okay that the rebated profits can be negative?
Yes.
The balance sheet of the households.
Yes. Okay. Yeah, so there would be a problem if this kind of gets too big, but as long as they're kind of small enough, I guess it doesn't matter. But it's a good point. Yeah. Good. Okay, so we have played around with that assumption. Going back to the question, is it important who they transfer to in our quantitative applications? Not going to be important in our theoretical analysis. I'm going to make the arbitrage very, very, very small, so it's also not going to matter. Marcus.
Given that the households own these intermediaries, if you were to give them the households SDF, would it change the model fast?
Yes, would drastically change the model. So that's kind of that would basically lead to market completeness from the household's perspective, because then the household can effectively trade the home and the foreign bond. So we either need a model of if we want to kind of model this more richly, of heterogeneous agents at home, where a large group of the agents cannot participate in that market, and there's a small group similar to the intermediaries that you have seen with Marcos and Yuli over this weekend. This is kind of a fiction. Let me also say this is kind of also, I mean, given a lot of the work that you've seen this weekend and also my previous work, it is maybe frustrating to model them as one period lived, and there's none of these wealth effects that I find usually also very interesting in driving the time-varying risk-bearing capacity of these intermediaries. We started this paper wanting to write that paper with endogenous risk aversion. Again, now it's kind of more of a wedge accounting exercise. We're first going to ask how much can this gamma t actually do, and then we can maybe start thinking about is it important to endogenize where this gamma t movements are coming from, and are they coming from losses maybe that the arbitrageurs are making on this balance sheet. So here comes now the question about the different prices. We make one additional assumption that I'm going to kind of go over very quickly now. In each country, there are firms that take the fruit of the tree, the apples in the US, and they make apple cake and apple sauce and apple juice and so on, and produce these various varieties, which they are able to sell at markups both at home and at foreign. And then Alessandria has this nice trick to use this kind of framework to then get dampened transmission of exchange rate to the terms of trade. So what we've seen the data is that the terms of trade move much less than exchange rates. And so the way this works here is that in periods in which the American consumer could now, because the exchange rate, the dollar has appreciated, could buy foreign goods much more cheaply, these foreign sellers are going to raise their markups so that the transmission of the exchange rate onto these foreign prices is going to be dampened. And that's going to help us capture that the terms of trade are more stable in exchanges. Not actually, neither quantitatively nor, again, in theory important. In theory, I'm going to turn that mechanism off, and there's going to be only one price. But it helps us match a key fact of the data in this literature. Market clearing, equilibrium, there are these varieties: apple juice, apple sauce, apple cake. They're the two endowments, the apples and the pears. And then there are the two bond markets. Those are the markets that have to clear in equilibrium. We have these 5 driving forces: time-varying time discount factors, time-varying supply, and time-varying risk aversion. And we're going to model them as multivariate AR1 process. That's the model. So
No price stickiness.
There's no price stickiness, exactly. Yeah. The model has a recursive representation in these 5 exogenous driving forces, and we need one state variable that captures how wealth is distributed between home and foreign. And so it's enough to keep track of one of those net foreign asset position. We take here the foreign bond position in the model. Now, the key equation in the model, the one that I'm going to really care about, is the one agent that is taking risk here, that has an active portfolio choice, is the arbitrageur. This is the first order condition with which the arbitrageur is thinking about taking on currency risk onto their balance sheet. You have a question before?
Yeah. Why is BT minus 1 not a state variable? Because BT minus 1 star is a state variable.
Sorry, why is BT1?
BT minus 1 a state variable.
Yeah.
But here we just say BT minus 1 star. I think maybe we should also add BT minus 1.
No, because markets have to clear things
So
kind of. I mean, there's only the kind of like as in a 2-agent model. Once I know the wealth share of one agent, I know the wealth share of the other one. So this is the same. This is the same exactly here. Exactly. Okay, so how does the arbitrageur think about risk? Again, I want to we'll talk through the talk as if the arbitrageur is taking on being long foreign currency. And so the arbitrageur holds, say, a long position in foreign bonds. I'm doing this because the empirical literature, Yun Shin and co-authors have shown international financial intermediaries seem to be long foreign currency and short dollar deposits. And so that's why I'm going to talk through it like this. So they hold some long foreign bonds. And this means they will want to be compensated for having that currency risk on their balance sheet. They will want to have an excess return on the foreign bond relative to the home bond. What is the expected excess return? Well, they buy this bond at the exchange rate Q, but then tomorrow, when the return is realized, when the foreign bond is paying off, we're going to have to flip it back into domestic currency, And so when the home currency appreciates, if QT plus 1 is going to up, then the returns on the foreign bond are going to be particularly low. And so there's going to be low expected returns. Great. So when does this expected return have to be high? Well, when that position that they have to intermediate is very large. If they're very risk averse, gamma t is particularly high, then this premium is going to go up. And then, of course, all that is going to depend on how much risk is there, how volatile is the exchange rate. Yeah? So these three factors are going to be driving the expected return. The way we're going to solve the model is going to be particularly simple, and I think both maybe nice, but also you've learned a lot of more interesting ways to solve models. It's kind of going to be the most simple, most rudimentary way to solve a model. We're going to do a first order perturbation. We're going to assume that this risk aversion coefficient, gamma t, has two components. Has a steady state component, gamma sigma, and then a deviation from that steady state, gamma hat t. And we're going to make that steady state component of gamma a function of the perturbation parameter itself. When we do a first order perturbation, we're saying, well, all the variances of our shocks, we let them go to 0. That's going to be the perturbation parameter in front of these variances of these standard deviations. But at the same time as we're going to do this, we're going to assume that this gamma, as a function of sigma, is going to go to infinity. And this is going to mean that as we are taking our first order limit, the product of our steady state risk aversion and that steady state, or that variance of our exchange is actually not going to go to 0, but it's going to have a finite number. And we're just going to pick that number as a parameter. This is, again, following directly Skokie-Mucken, and then also recent work by Moritz, and Sargent. Solving a model to first order, but keeping the product of price of risk and quantity of risk as a steady state variable floating around. We're doing, just to point out why, so this means we can first, I can show you nice analytical solutions, but we can also just put the model in Dynare and solve it very quickly. We're now doing the same. Today I'm showing you a 2-country version. In a few weeks, you're going to see on my website a draft for the same kind of framework, where we also include long-term bonds and short-term bonds on the arbitrageur's balance sheets, and we solve it for 30 countries. And we can do this because as we're taking the same limit, we're now not going to end up with one kind of gamma here, one risk aversion times variance, but now we're going to end up with risk aversion times a covariance matrix, and that thing is going to be a finite number, and we're going to have the whole kind of mean variance portfolio choice implications in the model, even though we can very quickly solve it by first order. Yeah.
Could you recap why the first order conditions? The first order condition is not only about returns, but we also have the position in the bonds.
Yeah. So if imagine you are an arbitrageur that has no bond position at all at the moment on the balance sheet, then on the margin you have no risk on your balance sheet. The extra epsilon unit you would not care about in terms of risk pricing. Right? But once you have loaded up your balance sheet, then you now start really caring about how much risk you have. So it's kind of the standard implication that the more risk you already have on your balance sheet, the more you care about a certain risk. Here, there's kind of only one risk, and the more you have on it, the more you worry about it.
And that's something realistic, let's say, that you have in your model. In the sense that it is true that arbitrageurs care more about the risk when their balance sheet is larger.
Is it really? That's kind of, I think, a feature that have you seen in all the papers that you saw this weekend. That is a feature. In, like, say you have any.
That's not true. Like, I think portfolio choice is proportional to risk, right? So these.
The portfolio share.
This is portfolio choice, right?
No. Here I'm talking about, but here I'm talking about the implied expected return. Yeah.
Mean variance utility is equivalent to CARA for portfolio choice, and with absolute risk aversion constant, and that gives you portfolio choice that is proportional to the level of wealth, not in proportion. So
how does your portfolio share evolve as the expected return goes bigger? Yeah. What happens? As the expected return grows in the mean variance portfolio choice problem, what happens to the portfolio share in the mean variance portfolio choice?
The
expected return goes up.
is increasing in wealth.
Exactly. That
It's
is
increasing wealth. Exactly.
not increasing in wealth. Like you're taking on more risk as the expected return is higher.
Yeah.
Yeah.
Yes. yes.
So you're saying you're agreeing with me that's a standard feature?
No, but that's a standard feature of CARA, not CRRA, that we've seen on this weekend.
No, but it's still the case that even in CRRA, you are kind of taking like the more risk I force on the balance sheet of an arbitrageur, even with CRA preferences, that now wealth starts to matter, right? So it's like kind of the effective risk aversion is now with CRA utility would be gamma over wealth. But if I force in equilibrium this arbitrageur to hold more risk, then this arbitrageur will need to be compensated by a higher risk premium. Yeah. So I think that feature of if in equilibrium, kind of I'm jumping now from a first order condition to an equilibrium condition, but if in equilibrium I force the arbitrageur to take on more risk on the balance sheet, then compensation needs to go up in terms of risk pricing. I think that's a feature that is true for CRA or CRA.
BT is a portfolio share or is an amount of?
Is an amount, because we're in a Cara world. Yeah. Exactly. Yeah, so wealth plays no role here because wealth is also not moving around. Yeah. To some extent, in a world in which arbitrageurs only live for one period, whether I model them as Cara or CRA, so second order is not important because with the CRA scenario, which is gamma over W here, but once I make them one period lived and give them always the same amount of wealth like in a preferred habitat model, it kind of does not matter. The moment I make them long lived, then there's a key difference between CRA and Cara. Yeah. No, perfect. Yeah. This is important. Yeah.
Related. BTA is not the same as BT star in the recursive representation. Right?
No, exactly. What is the difference? We know in equilibrium how much the arbitrageur has on the balance sheet and how much the foreign agent is borrowing. They have to add up. What is the only difference is, well, one is kind of the negative of the other. I should.
One's a share and one's a level.
No, both are levels.
Oh, both are levels.
Both are levels. Let me put this here. BT star must be equal to B minus. Let me make it like this. Plus B T, and then what my notation is an A star. With the only difference that now I need to put in here my size of the country in there. Yeah, so the country, the foreign household, how many of them are there? This is my number zeta star, plus what the arbitrageurs have to hold. That needs to add up to 0. So that's how they hang together, these two state variables. Very good. Thank you for clarifying. These are important questions. And also highlights really there is a key restriction here in terms of complexity of the model by making these arbitrageurs one period lived. And so a lot of the interesting questions that you are alluding to of like, well, what role does like with the preference choice and so on play, they don't happen here. Yeah, the other paper that was on the program is really kind of where we're trying to go from the Vianus-Wheeler preferred habitat model, which has kind of comes down in the fixed income space to this Cara utility specification. Is of course a lot more interesting once you make them long-lived and then give them CRA utility, because now wealth matters in kind of in line with what you've seen this weekend. And now we can think about how risk pricing is moving because wealth is moving around. We're doing things much simpler here, just exogenously moving risk aversion. But that framing it the other way, higher expected return, I'm willing to hold more quantity on my balance sheet. That's kind of shared across those two utility specifications. Thanks a lot. Okay, I think this is actually nice. By the way, I mean, I'm a big believer in first, second order linearizations. And as a starting point for any type you're doing, I think Linear is a great starting tool for even more complex and more numerically involved exercises. But I also think this toolbox of being able to kind of do risk pricing in a first order setting is actually surprisingly interesting, in particular in the international context.
But squeezing this into Linear is not that simple, right? Because Linear has a particular way of perturbing stuff. Or you just define one extra variable and that's it.
I treat this as a parameter. I just introduce this as a parameter. Yeah, and then this as a variation. So it's incredibly simple.
Okay.
Yeah. It's really, there's nothing I need to particularly do about Linear. With the I mean, yeah, there's interesting stuff once there's a covariance structure and the covariances are endogenous and I want to iterate over them and so on. If you work on this, I'm happy to talk on this. But the simple setting is actually very simple. Okay, but these are good discussions. I want to it's more important about like discussing tools and learning things. Given the time, I'm going to now show you theory. We make some simplifying assumptions. They make the formulas nicer. In the quantitative analysis, you're going to see they don't matter for our findings. I'm going to want to focus in particular on this idea. What are the co-movements that are induced by the different shocks? Q, kind of already referenced it. Q is going to be the price of the US consumption bundle relative to the foreign bundle. This means when Q is high, the US bundle is particularly expensive, the dollar is particularly strong. Yeah? I'm getting a particular high value when I'm exchanging the US bundle for the foreign bundle. So high Q, strong dollar. I'm going to focus now on the fluctuations between exchange rate and interest rate differentials and exchange rate and consumption differentials that my three set of shocks induce. Since I'm only thinking about co-movements, it actually doesn't matter in which sign these shocks are happening. And since for beta and z, it's all about relative differences between the countries. It also doesn't matter whether I'm looking at beta or beta star or z or zeta star. In the end, there are three sets of shocks in this model: the demand shocks, the supply shocks, and the currency intermediation shocks. The key idea is that we can kind of look at these co-movements and see that the shocks have different patterns in terms of their co-movements. First, let me focus on the exchange rate and the interest rate differential. The key idea is that the beta and the z shocks actually have the same co-movement in the data. Let's think about what does a beta shock do. Say the US gets more impatient. They want to consume more. That drives up interest rates in the US. Yeah? I'm going to think about all of this again through the one portfolio choice equation that matters in this model, the arbitrageur's portfolio choice equation, which I have here now already log linearized. So there's the excess return, R star, minus the expected appreciation rate. So the depreciation rate minus the home interest rate. How big should it be, that expected excess return? Well, more if the arbitrageur is very risk averse, and more if the arbitrageur has to hold a big position, coming back to our discussion before. So the US gets more impatient, US beta falls, the US interest rate goes up. The first step, nothing has happened here to the right-hand side. So we kind of treat this as if UIP holds, as there's a zero on the right-hand side. What has to happen to make this still work? Well, the arbitrageur now sees this higher interest rate, but wants to be indifferent between the investing in home and in foreign. And the way to get there is to say, well, if the dollar appreciates today, but then depreciates going forward, that is actually going to make it a lot more attractive to invest in the foreign bond. So what is going to happen to make this left-hand side hold is we're going to see an appreciation of the dollar today, and then a depreciation going forward. And that is going to make this left-hand side hold again. In equilibrium, there are going to be flows because the US is going to now borrow. And so something is going to happen here to the arbitrageur's position that is going to dampen that logic that I just told you. But this kind of first order effect that is happening on the left-hand side, that's going to dominate the direction of the co-movement. We can think about it also through the goods market, which may be easier than just jumping directly to the first order condition, is say, well, the US gets more impatient. They want more of their US goods. That's going to drive up the exchange rate. And then we're going to return to steady state. The exchange rate is going to depreciate going forward. Yeah.
So these are all claims about deviation from uncovered interest rate, right?
Here, actually, I was just saying, let's hold the right-hand side fixed for now.
Okay.
Everything that is on the right-hand side is a deviation from uncovered interest rate parity. Uncovered interest rate parity says the left-hand side is equal to 0.
Yeah.
But I say, as a first-order effect, what is the first-round effect, if the US gets more impatient and drives up the interest rates? Let's say nothing happened to our UIP deviation, whether it's 0 or it has a fixed level. Let's say what on the margin now is going to happen. Well, the US consumer is going to consume a lot. It's going to drive up the exchange rate. That's exactly what we also need here for UIP to hold, because the dollar is going to appreciate, depreciate going forward. It's going to make it more attractive to invest in the foreign currency.
And maybe I missed that at the beginning. You're not gonna talk about the covered interest by deviation.
Nothing. I have nothing. The whole project is nothing about CIP.
Okay.
I'm only talk about UIP. Exactly. Great. Okay, so the same thing is going to happen for the supply shock. Think about there's a recession in the US. TFP has fallen. Z has fallen. We're going to grow out of this. Interest rates are going to be high. real rates are going to be high. Again, through UIP, what needs to happen is the dollar needs to appreciate and depreciate going forward. That is going to make the left-hand side again go okay. We're going to see a high US interest rate and a strong dollar. Why do we going to see a strong dollar also from a goods perspective? Well, it's a negative supply shock. There's less of that US endowment around that makes the US basket more scarce, rationalizing in the goods market why the dollar is so strong.
Yeah, and there is no adjustment cost or anything
Nothing.
like that. No
Nothing.
overshooting.
Nothing. There's no the overshoot. We have no nominal rigidities. There's no adjustment in exports and imports exactly. It's a kind of very simple model. Yeah.
How much of that would be shut down if intermediaries were also allowed to service, say, forward rate contracts or option markets?
Nothing, because I mean they can price and they can really price anything here, but they have no one to trade it with, right? So the moment this goes back to the segmentation. If I open it up for them to trade more complex products with home and with foreign, then there's a question now: to what extent do we actually get close to market completeness by introducing these contracts? But as long as I'm keeping the assumption the home agent can only trade the home bond, the foreign agent can the foreign bond, I can use the arbitrageur's first order condition to price any complex product. It doesn't mean that it will not change anything in equilibrium.
Because also here, like all arbitrageurs sits at Wall Street, right? There is no like US arbitrageur and German arbitrageur, because then those two groups could trade.
But as long as they don't care about the home stochastic discount factor and the foreign stochastic discount, coming back to Marcus's question, there's a kind of, even that would not help to complete the market. Yeah. Yeah. Yeah.
So what is the micro foundation for the impatience? Like, is it?
Let me. Okay, I'll come back to this. Maybe probably I'll run out of time. So let me say this already. I of course don't want you to think about it as literally as patience shocks. In richer models, various other shocks forces, like for example uncertainty shocks in home or foreign, or actually risk aversion shock not to the arbitrageurs but to the home agents and to the foreign agents, will look like kind of precautionary savings and therefore demand shocks. Demographic changes will also have this feature that slowly moving the effective discount factor is going to change in models. There's models where fiscal shocks introduce these movements, and one natural candidate is to think about growth. Yeah, so I think like this kind of, let's say this going back to things have changed recently, but pre-January there was a period where the US has very high interest rates and the dollar is very strong. And I think one reasonable story is to say there's this idea that US interest rates, real rates, are going to be higher for a very long time because the US has this incredible access to a growth technology that's going to keep making the US grow faster than all the other countries, in particular, say, Europe, that seems stagnating at the moment. And so a growth shock will also look in a model, we're doing this in the appendix, in exactly the same way, going to drive kind of real rate differences across countries. But yeah. Yeah, let me take the moment to talk about monetary shocks. In an endowment economy, monetary shocks are interesting. Monetary shocks look actually like supply shocks. Why is this? Because a contractionary monetary policy shock drives down output and drives up real rates. That's exactly what the Z shock is doing here. The Z shock pushes down output and real rates are higher. And so if you want to think about the role of monetary policy shocks, we should think about are Z shocks playing an important role? I'm going to jump in a few minutes. I'm going to jump to the end of the talk and show you some empirics, some quantitative applications, and we're going to see these supply shocks. They don't do anything for the exchange rate. Great. So gamma shocks is the one shock that looks different. So here, let me highlight. So again, high US interest rates, low foreign rates, high dollar exchange rate. That's what B and Z shocks are doing. So this is this negative co-movement here between the foreign interest rate differential and the dollar exchange rate. The gamma shocks look exactly different. The gamma shocks, they're shocks directly to the right-hand side. If gamma goes up, we need higher excess returns here on the left-hand side. We can generate these through two things. First, higher real rates in foreign and lower real rates at home, or a dollar appreciation and then a depreciation going forward. Both is going to make it more attractive to invest in the foreign country. In equilibrium, both of these effects are going to happen. And that both of these effects are going to happen, that leads to this positive movement between the dollar shock. So to all your questions about the flight to safety, the specialness of the dollar, risk premium shocks in financial markets, all of these are going to be shocks always to the right-hand side here. Say a convenience shock means the observed rate on the dollar is particularly low relative to foreign countries. So this is really something about we need a wedge here on the right-hand side. Whenever we are moving around this wedge here on the right-hand side, what we're going to get in these models is that the dollar is strong, not when US interest rates are high, but actually when foreign interest rates are high relative to very low US interest rates. And so the gamma shock looks different in that setting. You can also look at exchange rate and consumption differential. And kind of with the beta shock, we already know the dollar is going to be strong. When the US is very impatient, it's going to consume a lot. So the dollar is going to be strong when US consumption is high, but foreign consumption is low. So there's this negative co-movement here. Gamma shock, the same thing. Say the arbitrageur was lending to foreign. Now they don't want to lend to foreign anymore. Foreign needs to repay their debt. It's the foreigners that are now consuming a lot in a period where the dollar is appreciating. And so again, we have this negative co-movement. It's only the supply shock that has this typical Backus-Smith co-movement. And it's nevertheless in this incomplete market setting. Why? In a supply shock, as I said, recession in the US, scarcity of the US basket, of the US good, the US dollar is going to appreciate, but it's also a time when there's just not much US consumption around. So US consumption is going to be low. Foreigners are consuming relatively more. And so I'm going to get this positive co-movement. So you look at this table, and you think I'm doing now a sign-restricted VAR, right? Because I can actually have 3 shocks and these 3 signs. I'm not going to do this. I'm just going to go to the data with those co-movements and look at how does the data look. And it could look like noise, because these 3 shocks, they all kind of move things in opposite directions. So we should, even through the lens of the model, not be surprised if we don't see any pattern. If it was all gamma shocks, as the recent literature has argued, we should see these positive and negative co-movement very starkly. I'm going to show you now what we're seeing. On the left-hand side, I'm showing you in light blue the interest rate differential. I'm taking 10-year nominal rates between foreign and the US. And then in dark blue is the real exchange rate weighted across all these different countries. Yeah. Perfect. So kind of we don't have these nominal rigidities. There's a lot of things that happen kind of on a cyclical frequency to short rates in a richer model that we're not capturing. In the end, we are also really interested in, I mean, what the data is going to show us, we're going to be interested in very slow-moving, persistent effects. And the 10-year rate maybe is particularly good at picking that up. The pictures also look similarly good with short rates. But we're going to let in the model the home and the foreign agent price long-term bonds. And then get that link to the data. But it's a good question, and the appendix kind of has all the comparison. The 10-year rate kind of picks up naturally what we want to look at. Yeah.
I feel like actually the physical shock is similar to gamma shock.
A physical shock?
Yes, like maybe additional issuance of treasuries will have the similar.
An issuance shock. Yes, absolutely, absolutely. Issuance shock would also again move the right-hand side. So these are all everything that moves convenience yield, moves flight to safety. Moves risk premium in the currency markets will look like something that happens to the right-hand side. I agree. We're kind of treating it as one particular shock, but in the end, we're picking up a wedge, and richer models can speak more to what is driving gamma. And also, what is going to drive gamma is how do we now, through the wedge accounting, where do we see in the data gamma occurring, right? And that's maybe going to teach us something about what are the right shocks. Yeah, absolutely. So on the right-hand side, I'm also showing you the real exchange rate in dark blue. But then in light blue, consumption differentials, G10 versus the US. Okay, so what do we see? Well, the dollar seems to be most of the time strong when foreign interest rates are low and US interest rates are high, relatively high. And the dollar is weak when foreign interest rates are high and US interest rates are relatively low. If you look at the broad co-movements, that's is a very clear picture. And the same negative co-movement you can see for the consumption differential. These are slow-moving, persistent series. So it's kind of, we shouldn't make too much of the R squared. The appendix is a great time series econometrician colleagues here that taught me everything about making sure that the sign of these co-movements can be significantly established as being negative. And the answer is yes. These co-movements are significantly negative. And this is robust to nothing especially here. First, about the dollar, we can use different base currencies. We can do this bilaterally. We can add additional control variables. The negative co-movement is significant. And this kind of the key message of the paper must mean that demand shocks are likely the main drivers of the exchange rate. If it was all supply shocks or monetary policy shocks and so on, it would be very hard to explain these co-movements with consumption. This is kind of the standard Backus-Smith puzzle. Rather than a positive co-movement, we're finding here a negative co-movement. If it was all shocks to the right-hand side, issuance shocks, convenience yield shocks, and so on, well, then it would be very hard to get this negative co-movement. We should see this positive co-movement here on the left-hand side. And so then The question that now, after showing you this data, comes out and is, can this kind of quantitatively hang together? The other question is, how can it be that we are now arguing that something so fundamental as demand shocks can drive the exchange rate if kind of we feel like the macroeconomy is clearly not moving that much? I won't have time to really go particularly deeply here, but the key idea is that as long as these shocks are persistent, then persistent shocks can lead to very large interest rate fluctuations. And the idea that you kind of see here in this iterated UIP condition is, imagine there's a very persistent impatience shocks, as I talked about in the US. The US gets more impatient, and real rates in the US are for many, many periods now higher. Then for many, many periods, there's going to be this interest rate differential, real rate differential. And for many, many periods, the arbitrageur needs to be compensated by a depreciating dollar, because a depreciating dollar is going to make it as attractive to invest in the foreign bond. This is kind of the sum here of all these future interest rates. And to get this path of depreciation for many, many periods, the initial jump in the exchange rate needs to be massive. And so small but very persistent movements in interest rate differentials can then lead to large movements in the exchange rate that also make every step of the way the exchange rate actually very hard to predict going forward.
Since we're motivated by the time frame in the picture, philosophically, how can we differentiate between the shock being more persistent versus some transmission mechanism causing the persistence? So it could be that you have a bunch of noisy, short, like demand shocks, but it's a transmission mechanism that means you get the persistence from it.
I'm kind of, again, this is kind of, as a wedge, kind of, I need, like, the wedge needs to be persistent. And so if it is a wedge that looks like what is the wedge to beta or wedge to gamma, that needs to be persistent. How you get that persistence, I don't know. That's kind of up to the details of the model. So I've kind of 2 minutes, 1 minute in which I want to say, this kind of should be kind of surprising to you. I thought one cannot make sense for exchange, at least was surprising to me. There's actually like kind of surprisingly stark co-movements. I'm going to make this now even more stark. We're going to go to the model, do very standard things like output series, get the output series from the data, match the supply process in the data. Gamma, we're going to use the excess bond premium, kind of often used measure for risk-bearing willingness of the arbitrageurs. Beta and beta star, we're going to match the 10-year yields, going back to the question why the 10-year yields. The key thing that comes out is that the beta process is going to be very persistent. Why do we know this? Well, the interest rate movements in the data are very persistent. These interest rate differentials move very persistently. The financial variable that we're using, the excess bond premium, is not very persistent. It's going to be very cyclical. I think actually all financial variables that we have look very cyclical. But it's going to be a key difference to Itsukoki-Muken, who have a very, very persistent driver of these noise traders. So these noise traders have a quarterly autocorrelation in line with our quarterly autocorrelation of the beta shocks in the original Itsukoki-Muken model. The question is, who are they? I think as long as we don't have any observable variable in financial markets that looks as persistent, I kind of feel more comfortable giving them a low persistence. And the interest rates, I'm actually seeing that they're very persistent. The different persistence means that on short frequency, exchange rate changes over 1, 2, 3, 4, 5 quarters are going to kind of be equally driven by gamma shocks and by these patience shocks. But the slow-moving, broad co-movements of the exchange rate, they are going to be largely driven by the demand shocks. And so that's kind of the key message of the data. Yes, day-to-day exchange rate movements, of course, are affected by financial markets. Cyclical frequency, of course. Over longer horizons, the exchange rate seems to be driven by something that looks more fundamental and slow-moving. Let me just skip over this. The model gets the co-movements as we observe them in the data, right? It needs for this is just a table that I showed you, the plus and minuses. This is exactly what's coming out in the quantitative model, these co-movements. The key is the beta shocks, is getting the co-movements right as we are seeing them in the data. There's a distinction between Itsukoki-Muken, this co-movement between interest rates and exchange rate. That's really what's distinguishing the models, and we think is a key moment. It's not a new moment. 70s, 80s exchange rate literature is all about interest rate differential and exchange rate. That said, of course, we need still a UIP shock because of high frequency. We know there are these UIP puzzles. There is this deviations from UIP. That's what the currency intermediation shock is doing in our setting. Last exercise I want to leave you with, this is the exchange rate in the data. We can take the model and just use the beta shocks, the Z shocks, and the gamma shocks to target interest rates, the risk aversion, the excess bond premium as we're observing it, and output series as we're observing it in the data. Invert the model without targeting the exchange rate directly. Even if we're just using beta shocks, we're getting the broad path of the exchange rate right. But now going to various drivers, of course there are deviations. There are periods, and let's just let me end here on the 2008. In 2008, low interest rates in the US, nevertheless a strong dollar. How is this possible? Well, we need these UIP shocks, also a time in which any measure like the excess bond premium spikes. And so including that improves the fit of the model. In terms of the message for you, this goes to what is this? What are these beta shocks? Clearly, they're not really patient shocks. Fiscal policy, credit condition, demographic, uncertainty, growth. I think there's kind of very interesting things to explore. Talking to John before about like the emerging markets, I think we are kind of don't see the same patterns for emerging markets. There's something very interesting happening in the cross section of countries and exchanges. Kind of a lot of work to do in international macro and international finance. I'm out of time, so let me just leave the conclusion slide here for you, and I'm happy to chat after. Thank you.